Well, welcome back. Just doing a little bit of trail maintenance here. Take a little break and do a quick review of essentially what would be Module 2, where we covered the income statement, changes in equity, balance sheet, cash flow, and time value of money information. So take a little break from working, just doing a little bit of trail maintenance. This is a rough part of the trail. My wife complained that it was a little difficult, especially if she was carrying the 2-year-old on her back. So I'm going to try to level this out a little bit, make it a little bit more clean walkway down to the flats. So in the meantime, we'll cover Module 2 review. So as I mentioned, Module 2, we covered the income statement and changes in equity broadly, which includes income, other comprehensive income, and then the preparation of the income statement and all the equity statements, including statement of retained earnings that we spent some time on. So that was essentially what would have been Chapter 4 in the Wiley Intermediate Accounting textbook. So we talked very briefly. A lot of this is going to be review. So you should have already heard all this if you've been through all the prior lectures, but I'll do a quick high-level summary of what I think are some of the main points, main takeaways, or at least allude to the ability to do something at this point in the course. So we did talk about income statement in terms of limitations on the income statement. These largely also apply to the balance sheet, which we'll touch on very briefly when we get to that later on in this discussion. But so limitations of the income statement fails to identify all aspects of the firm's financial performance. So for instance, it doesn't capture any changes in intangible assets because we don't capture intangible assets. And then uncertain future expenses and future revenues. Income statement does a poor job, or accounting in general does a poor job of capturing and putting on the statements for users. So that was the income statement's failure to identify. In terms of measurement, it relies very heavily on a number of estimates. For instance, the estimates associated with collectability of sales, what would be considered our provision for doubtful accounts or bad debt expense. That relies on some kind of estimate. There's a lot of estimates in terms of realizability of asset values over time, everything down to like depreciations, assuming we're going to be able to realize the asset value over the life of the asset. So that's imprecision in measurement. And then we have incomplete and I'd say delayed communication of performance as part of the income statement. Income statement doesn't come out for at least four weeks for some of the fastest public companies. You get a private company and you're talking like by April, oftentimes before they issue their financial statements for the year end. So 4 weeks to 4 months kind of delay, which is not necessarily timely. So those are some limitations. The income statement has a lot of value in the sense that it's tracking the performance of the company. It's used to project future cash flows. There's been a lot of studies showing that net income is a pretty reasonable predictor of future cash flows for companies. It's not perfect, obviously, but it does a reasonable job of predicting future cash flows, and it actually generally does a better job than current cash flows. So that's why we use accrual accounting, broadly speaking. If we move on, we talked about earnings quality and this idea that there can be earnings management, where management actually intentionally manipulates or interferes with the accounting measurements or accounting statements to make them reveal what management wants them to say. Now, there's a good side of this in that we want management's knowledge of the company and of the performance of the company to come through. However, we don't want their biases to come through. So it's kind of a trade-off. And when we refer to earnings management in the accounting literature, we're typically referring to management manipulating from introducing their own bias, or even worse, actually moving on to almost a fraud level of managing earnings to achieve stated benchmarks. So that's earnings management, which affects earnings quality, or the quality of the earnings that are being reported on the financial statements. So we moved on to actually the preparation of the income statement, where we have the income statement. There's a single step and a multi-step. Almost everybody uses a multi-step, which separates operating transactions or revenues and expenses from non-operating transactions, which we refer to as gains and losses. The multi-step also does a good job of matching costs and expenses with related revenues. So that's why on most income statements, you see sales and then you see cost of goods sold to give you gross profit. Well, that's a multi-step. It's showing that that we can match up cost of goods sold with sales to give us this gross profit figure. If you had a single step, you just list all your revenues and then all your expenses. There would be no matching, or I'd say intermediate steps in the net income process, which do provide value and provide relevant information for investors. And that is why most companies are reporting a multi-step income statement. So we have elements of the income statement. At this point in your accounting progress, you should basically know the definitions of the elements of the income statements. That's revenues, expenses, gains, and losses. Those are the 4 elements that end up on the income statement. Revenues are inflows or other enhancements of assets or settlement of liabilities that constitute the entity's ongoing or major central operations. The key there is ongoing and major central operations. Expenses match up with revenues. They're the outflows or the using up of assets or incurrence of liabilities that again constitute the entity's major ongoing or central operations. Revenues and expenses are their main operations. Now, gains and losses are peripheral or incidental transactions. They are not revenues and expenses. They're things that don't constitute the ongoing major or central operations of a company. And they get reported generally on a multi-step income statement. They get reported later so that investors can kind of determine, okay, in terms of their core operations or what the company is trying to achieve with its business objectives, how are they doing? Regardless of how they do in some incidental things, like if they sell some assets and make money on them, or they sell assets and lose money on them. We don't want that confounding how they're doing in executing their core strategy. So that's why we separate revenues and expenses from gains and losses. So there are some other items that get reported on the income statement that are relatively new. If you've taken, say, principles of accounting, you probably didn't deal with a lot of these other specific items. For instance, discontinued operations, non-controlling interests, and calculating earnings per share, although oftentimes you will have calculated earnings per share at this point. So discontinued operations are the operations of the company that represent a significant component of the company that the company is no longer performing. So they are discontinuing that segment or that business and won't be reporting it in the future. That gets usually disclosed separately. It gets disclosed below income from continuing operations, and it gets reported net of tax. That is discontinued operations. And that way investors can look at income from continuing operations and use that information to project, okay, well, given the operations that are going to be going on in the future, what do we expect net income to be, say, in the future, based on what we are reporting today. So non-controlling interests get reported essentially after net income, consolidated net income. So on a consolidated income statement, we have consolidated net income, and then we subtract out income or loss associated with non-controlling interests or minority interest holders, depending on the terminology used by the company. And that again is reported net of tax, and that is the minority interest holders portion of businesses that are controlled by the consolidated entity. So if they own 51%, they're going to report all of their revenues, even though 49% of them actually belong to somebody else. Well, that 49% gets taken out as non-controlling interests. And that is broadly done because if you own 51%, you control those assets. So the income statement lists all the assets that the company controls, whether they have a 100% ownership interest in those assets or in that revenue or not. So as I mentioned, discontinued operations and non-controlling interests are reported net of taxes. So I worked through a lot of examples when I did the full lecture in terms of how we view income net of tax or intra-period tax allocation. If this is something you're struggling with, I encourage you to go back and walk through those examples or watch those examples as I walk through them until you really understand what's going on. That's pretty critical. And I would say just from a high level perspective, the starting point is to view taxes as a rate. Don't view them as a tax return per se. From a financial statement standpoint, view taxes as a rate. We apply a rate to income from continuing operations. We apply that same rate, or we apply a rate to income from discontinued operations, and we can apply that rate to non-controlling interests. And that's how it gets laid out separately on the income statement. So quickly just reviewing earnings per share. So the last item reported on the income statement of companies is going to be earnings per share. Earnings per share is the net income minus preferred dividends divided by the weighted average common shares outstanding. So that is the amount of shares outstanding if it's weighted over the course of the period. So if the company issues shares midway through the year, obviously those weren't outstanding the whole period, so we only take basically half of those shares because of half of the year that they were outstanding, not the whole amount of shares that were issued, say on June 31st. This is obviously a significant business indicator. As a shareholder, this tells you how much earnings you have in the company for every share of stock you own. It's a pretty important metric, especially as over time, companies can issue additional stock or they can redeem stock, which would change that average, the weighting of common shares outstanding. But you're interested in what you own, or what revenue or net income is attributable to you as a shareholder, so per share. So that's why that measure is so important. And that has to get disclosed on the income statement. It's usually some of the last items reported on the income statement. Okay, so my camera totally kicked it while I was working on the trail. So I had to move everything back up here. I ended up doing an additional basically 45 minutes of lecture that didn't get recorded. So I'm doing everything again. So here we go. We left off with talking about the income statement. I'm going to wrap up that section with reporting of accounting changes, errors, and estimates. Changes and estimates. So changes in accounting principles and accounting errors are both adjusted retrospectively. So if we have a change in a principle, or we select a different accounting principle, say we change our inventory method or something, what we do is we go back to basically the earliest financial statement being reported, we change it there so that we have comparable financial statements going forward. And that way, so let's say you look at the set of financial statements and it has last year's and this year's net income and cost of goods sold in there. And it looks like, oh, cost of goods sold went down by 5%. Well, we want to make sure that that 5% is legitimately reflecting that the cost of goods sold went down by 5%, and not that we switched our inventory method and that caused cost of sales to go down. We don't want accounting to itself cause differentiation or cause essentially incorrect interpretations of the financial statements. Now, that may happen for any number of other reasons, but to the extent we can constrain that by changing everything going back as far as we can, that's how we're going to do it. So changes in accounting principles are retrospectively adjusted. So we recast prior periods to reflect the change. The same thing with errors. If we messed up the accounting last year, or the company misreported something on their financial statements last year, they're going to go back and fix it last year or the year before that, or if it ends up from a period well before that gets then being reported currently, it goes into retained earnings, or beginning retained earnings on the earliest set of financial statements being reported. So that is how we do accounting errors. Also retrospective. Now, if we were to fix accounting errors in the current period, then the current period's wrong. So if we had understated income 5 years ago and we decided we're going to fix it, we would fix it by increasing income now. Well, that's an error then. So we want to try to constrain that error to the period that the error actually occurred in, which in this case was a number of years ago. So those changes in accounting principle and accounting for errors are done retrospectively. Now, alternatively, when we change an accounting estimate, let's say we estimated bad debt expense at something last year, it didn't end up being correct, so we changed it this year. Or we estimate the useful life of a piece of equipment, and then we decide a couple years in that, oh, well, it's actually going to last a lot longer, or it's going to be a lot shorter. Those are changes in our estimates that we're making. We don't go back and fix it. We change it going forward. It's called prospective adjustment. And that's just because if that was the case, we would constantly be reissuing or changing our prior year financial statements, because our estimates are never perfect. They always are different than reality. That's why they're called estimates. So if the estimate, assuming the estimate was made in good faith at the time with the best available information at that point in time, that's not an error. We just need to fix it going forward. So we are re-estimating. If you take like the useful life of an asset, let's say we started with 10 years, now we think it's going to be last 15, so we need to extend it. Well, what's to say our 15 is right? Maybe in 2 years we'll say, oh, well, that was wrong. It's actually going to be only be 12. So we don't want to go back and have to constantly be basically adjusting previous financial statements because our estimates didn't end up being correct. That would be a fruitless exercise. So that's accounting for changes, errors, and estimates. Moving out of the income statement onto statement of stockholders' equity. Statement of stockholders' equity reports changes in each stockholders' equity account and the total equity for the period. So we do this essentially through a roll forward method, where we start with the beginning balance. We roll it forward, so we show all the changes in our stockholders' equity accounts that gives us our ending balance. So if we take, say, retained earnings goes up if we have income, it goes down if we have a loss, and then it goes down if we issue dividends. So we take dividends out. Those are usually the only two things that change retained earnings. So the statement of stockholders' equity, the column that has retained earnings in it, would say beginning retained earnings plus net income minus dividends gives us ending retained earnings. We would do the same thing for all of our stockholder equity accounts, including, say, common stock. If we issue shares of stock, we would say stock issuance, so that account would go up. We have the beginning balance plus the stock issued gives us our ending balance. So that's how we handle stockholders' equity statements. So the statement of stockholders' equity is really a big table with columns for each account and then showing all the changes in those accounts, giving us our ending balance. Typical accounts for stockholders' equity: common stock, additional paid-in capital, retained earnings, and accumulated other comprehensive income. Those are the most common. You could also have treasury stock or preferred stock in there as well. So that wraps up our equity statements. We talked a lot about other comprehensive income. That's a relatively new concept. We do have a statement of other comprehensive income, or alternatively, you can present it just as the second part of the income statement, ending with comprehensive income. But other comprehensive income captures changes in equity that aren't related to interactions with investors, say dividends or issuing stock. So it's changes in equity that don't flow through the income statement. So the changes in equity that do not flow through the income statement go through other comprehensive income. And the idea is that there's these things. Generally, these are capturing the fluctuations in the value of assets and liabilities on the balance sheet. We don't want those going into net income because they don't really represent the operations of the business, but we still want to try to get the balance sheet correct, or at least to represent some underlying value or some underlying liability or asset. So we're just going to push those changes. Instead of going through the income statement, they're going to go through other comprehensive income. The most common of those would be gains and losses on available for sale debt securities, foreign currency translation adjustments, and the valuation changes in some of our pension liabilities or over time. So those are the most common things that flow through other comprehensive income. Moving on to our balance sheet. Our balance sheet, sometimes referred to as a statement of financial position, reports assets, liabilities, and equity as of a specific date, provides information about the resources, obligations, and creditors, net equity, and net resources available for management to use, and it helps in predicting future timing, uncertainty of cash flows, principally the current assets and current liabilities. Some of the uses: it's used predominantly in returning the performance of management. So how is management doing? This idea that the assets on the balance sheet represent the resources available for management. So if we want to see how well management is utilizing those resources, we calculate return on assets, which is net income divided by total assets. And that tells us, okay, well, how much net income is management generating for their assets that they have on their financial statements. It also gives us some like liquidity, solvency, financial flexibility when we start looking at current assets, current liabilities, or how much cash are they going to be bringing in versus how much they're going to have to be paying out. Provides whether the company's actually liquid, how debt heavy they are. So we look at our liquidity ratios or leverage ratios for the company. So those are some of the uses. Limitations, again, very similar. It doesn't capture any intangible assets. That's pretty straightforward. The balance sheet is presented as of a point in time, which is generally not a problem, but sometimes that doesn't reflect actually what's going on in the company. We take an example, a very extreme example like Lehman Brothers, where they actually entered into transactions to take high-risk assets off their balance sheet at quarter end so they wouldn't have to report them. And therefore, then investors and regulators didn't even know that they had these high-risk assets on their balance sheet when they actually did. So the point-in-time measure actually caused some problems with Lehman Brothers, and that is a limitation on the balance sheet where we basically ignore or don't even identify assets that come and go within a quarter on the balance sheet. Measurement, a lot of the assets and liabilities are still reported at historical costs on the financial statements, and they incorporate a lot of estimates, which introduces management judgments and biases. So those are some measurement issues. And then just like the income statement, the asset or the balance sheet is not overly timely. It's like 4 weeks to 4 months before it's being reported to investors. The elements on the balance sheet, as I mentioned, we have assets, liabilities, and equity. At this point in your accounting education, you should start knowing the definitions, or at least pretty well. I wouldn't say, I'm not going to ask you to like say quote the definition for me, but so assets are probable future economic benefits obtained or control of a particular entity as a result of past transactions or events. So that is the definition of an asset. Liabilities are also very similar. They're probable, except they are probable future economic sacrifices, or the probable future sacrifice of economic benefits. So if assets are the benefit, liabilities are the probable future sacrifice of those benefits. There's some key aspects of these. They have to be the result of past transactions or events. That's critical. It can't be something you expect in the future. For instance, you can't have a liability for something you think might happen in the future. It has to have happened. So for instance, you can't have a liability for potential litigation unless it's probable. That would be the probable future economic sacrifice, right? So, but if there's been no litigation and no reason to think any more reason to think that there will be litigation in the future, then you can't have a liability for litigation. Companies used to have that a lot. You primarily, kind of the late 90s, it became a big issue. Not that that's the only time it happened, but that's when it became an issue and they started actually trying to address it. And they called them cookie jar reserves, this idea that in good times you would build up these liabilities, i.e. not recognize income, you'd build up these liabilities. Then in bad times, you would take these liabilities down into net income, and it would kind of smooth your earnings, which is a form of earnings management, going back to some earlier discussion. But that's not allowed anymore. We have to have probable future economic sacrifices resulting from past transactions and events. So those are some of the key aspects of the definitions of assets and liabilities. In terms of equity, we have residual. Equity is just the residual interest in the assets of an entity. The definition is assets minus liabilities. That's the definition of equity. So it's the residual interest in assets of an entity that remain after deducting its liabilities. Assets minus liabilities equals equity. So those are our main elements. Within those, we do have subclassifications. So within assets, we have current assets and say current liabilities. Current assets and liabilities are things that will convert or require cash, or assets if it's a liability. So basically, it will on the asset side, a current asset will convert to cash within 1 year or one operating cycle, whichever is longer. Now, most companies' operating cycles are less than a year. Occasionally, you'll get an operating cycle that is more than a year. In say, if you're doing like land development or large construction projects, where you could be in a construction project for a year or multiple years even, in which case the operating cycle is longer than 1 year. So the current assets would be converting to cash outside of a 1 year period. But again, for most companies, that is the 1 year is the benchmark. So that's current assets. We also, on the asset side, we also have investments. Those can be long-term or current. We have property, plant, and equipment, intangible assets, and other assets. That's generally the ordering on the balance sheet. Everything gets ordered on the balance sheet in order of liquidity. So within the current assets, we start with cash because that is cash. And then the next thing to convert to cash is usually accounts receivable because we collect them. The next thing is going to be inventory. So the idea is we sell inventory and then we get an accounts receivable, then we collect accounts receivable, and then we get cash, right? So then it would be inventory would be next. And then usually you would have, I'm trying to think what else you would have on there. Supplies might be next, and then prepaids is usually last. because it usually extends out over at least a 1 year period, and it doesn't directly convert to cash, it converts to a benefit. So it's usually, prepaids is usually kind of the last current asset list reported on the balance sheet in terms of order of liquidity. Within liabilities and equity, so liabilities, again, they're the probable future sacrifice of economic benefits. There are current and long-term. Current would be, say, accounts payable, salaries and wages payable, for instance. Those are going to require cash, or their obligations that the company reasonably expects to liquidate, either through the use of current assets or the creation of another current liability within a year or one operating cycle. So long-term means it's obviously everything beyond that. So those are our two broad categories. Moving on to stockholders' equity, we have different stockholder equity accounts. They all typically get reported. Capital stock, that is the par value of the shares outstanding. Par value is usually like 1 cent or 1/10 of a cent per share. It's done that way for legal liability reasons associated with the sale of stock, but it's usually a very, very small number. So that's the capital stock. And then you have additional paid in capital, which is everything in addition to that par value or the stated value that the company received when it sold its stock. So that's the additional paid in capital. That represents the contributed capital of the company. Now, then after you have contributed capital, then you have the earnings or losses associated with the company. We have retained earnings, which are the corporate earnings that haven't been distributed. They are retained by the company. They aren't distributed. So that is retained earnings. Again, net income goes in there and dividends go out, because dividends, if we pay a dividend, we have not retained the earnings, we've actually paid the earnings out as a dividend. If the company has more historical losses than they do earnings, they typically will report accumulated deficit instead of retained earnings, because they're not earnings, they're actually losses. So they call that typically an accumulated deficit or accumulated losses. But it's essentially the same account. Next, we have accumulated other comprehensive income. Just like retained earnings captures net income over time, accumulated other comprehensive income captures other comprehensive income over time. So every year we have an amount of other comprehensive income. The effect of that flows into the accumulated other comprehensive income every period. So that's an account that just accumulates every year's comprehensive income. We also can have treasury stock that's generally reported at the cost the company purchased it for. So treasury stock is the company's own stock that it has bought in the active market. So it can buy its own stock and hold it. It does not get to report gains and losses on its own stock. So that is why it's reported at cost. It can choose to either sell it back into the market or to retire it. Those are kind of its options. So that's treasury stock. And then you also have non-controlling interests. Again, if we go back, these are consolidated financial statements. So if we're issuing consolidated financial statements, there are subsidiaries where we may not possibly own 100% of, but they're still consolidated. So we have 100% of their assets and 100% of their liabilities. However, the difference of that doesn't all flow to the equity holders of the company. So we take that out as part of non-controlling interests or minority interests. It gets shown there in the non-controlling interest line item on the equity statement. So there's a number of different ways that a lot of information gets presented or disclosed in the financial statements. We've talked largely about the core financial statements, like the balance sheet, income statement, statement of cash flows, statement of stockholders' equity, are what we would typically call the face of the financial statements. Behind that, we have all the notes. Notes include a lot of additional information, everything from the accounting policies that the company has to different tables or breakouts or additional information for line items disclosed on the face of the financial statements. So those are the notes to the financial statements. They provide a lot of additional disclosure information. We can have parenthetical explanations. For instance, it's not uncommon to see parentheses around, say, if we report accounts receivable, in parentheses it'll say something like net of allowance for doubtful accounts of X number of dollars, right? That's a parenthetical explanation. It helps get you to the net accounts receivable that's being reported on the face of the financial statements. We can cross-reference items, so we could say other assets, and then see note 15, which says, okay, go see note 15, it'll tell you more about what the other assets are. That way we aren't cluttering up the balance sheet with a bunch of other assets that aren't generally material, most people don't care about, but if they really do want to see them, they can go into the notes and see that where we cross-reference it. Supporting schedules help, again, they support the balances set on the face of the financial statements, and the notes often discuss terminology and definition stuff. So that pretty much wraps up our balance sheet. Good luck and God bless.